Welcome to Real Turkey, the economy episode. I am your host, as always, Guldem Atabay, and my regular guest is Atilla Yesilada. Hi, Atilla.
Good morning.
Good morning. So, on the economy front, there is some action, as always, in Turkey. Just last night we've seen the Fitch downgrade for the government of Turkey, or our President Erdogan sacking our central bank governor over the last weekend. We've seen the threats of, on the political side, the threats of sanctions for Turkey about the S-400 purchase, and European Union threats for further sanctions for the Cyprus drilling issue down the road. But what we've seen as so far was a limited reaction on the lira front. What do you think? What's behind the Fitch downgrade? Why the market was kind of calmer, given that our president is openly taking control of the monetary policy in Turkey? What are the reasons for this? Do you think the Fitch downgrade will have any strong impact on lira in the week ahead?
First of all, I'm not a subscriber to Fitch, so I only read the press coverage of their reasons. It appears, as you suggested, that they're quite concerned about the removal of the central bank governor. Of course, for modern democracies, central bank independence is very important, and our President Erdogan doesn't seem to understand that his right or authority to remove the central bank governor for any reason whatsoever means that the central bank is no longer independent and that the monetary policy is made by the president or his team at large. That also adds to Fitch's worries by concerns by other credit rating agencies expressed repeatedly that the institutional framework of Turkey is deteriorating rapidly, and Turkish policy making or reaction function is no longer foreseeable. Obviously, these are great concerns to bond investors who buy 5-year, 10-year bonds and who wish to have some kind of visibility. So it was understandable, in my view. Whether it's going to have a major impact, not in the Turkish markets, but Turkish Euro bonds reached a 3-week bottom after the announcement. Turkish 5-year CDS prices jumped over 400 basis points again. So I think not only credit rating agencies, but the international investment community is worried about it too. On one hand, of course, all of these are happening in tandem with the delivery of S-400s, which are also a reason for sanctions. But on the other hand, Fed expectations are also helping countries like Turkey. So to me, Fitch rating decision was important. I don't think it's going to affect the currency too much, for the simple reason that as of May, Turkey began running current account surpluses, which is really a rarity. It happens very seldom. And from tourist data, I understand we're going to have a very good summer season. And finally, to the extent I recall, the foreign debt payments or amortizations over the summer months are relatively light. So with most of the foreign investors being on the sidelines, there is not going to be that much pressure on the Turkish lira. I think if Turkish sovereign, that's the treasury, or Turkish banks and corporates wish to issue new bonds, they're going to pay wider spreads. They already are paying very wide spreads. And the Turkish Eurobond sell-off is very likely to continue if Fitch downgrade is coupled by new warnings from the White House or Department of Defense about sanctions.
As you said, we've seen some macro data this week. As you said, the May current account balance now is in a surplus, marginal one, like $151 million. But last year it's coming from a $6 billion deficit. So what's behind this surplus, and combined with our economy minister Albayrak's comments that we are going to be seeing positive current account figures down the road through the summer months. Is this sustainable? Is this even good? Is this even a positive thing for Turkey? And given that, okay, now it's aiding the currency's stability because it's the summer months, tourism season. We're posting current account surpluses. But then we have looking forward for the 12-month period, we have another 175 billion US dollars to pay from the real sector, including the banks. And what we're seeing as again this week was in the May industrial production, the contraction level was the lowest for the past 9 months. It was 1.3% compared to last year. Some people, some economists, some journalists are talking about economic recovery is just beginning in Turkey. How much to recover? How sustainable can this be given all this tangible sanction possibilities and political volatility in the months ahead?
Well, starting with our economy maestro, Mr. Atabay, of course, he's a politician and he puts the best spin on economic data. He's literally speaking, he is correct. Current account surpluses are good from a balance of payments perspective. But from an economics perspective, of course, one would want current account surpluses driven by exports. This is not the case in Turkey. The reason why the external balance shifted to a surplus is simply because Turkey ceased importing. Now, of course, being a bleeding heart socialist, if import reduction came purely from consumer goods, I wouldn't be worried about that. But perusing through the data, I see that we no longer import raw materials, intermediate goods, or capital goods, which simply means there is no domestic demand. So, if Turkey is willing to live with a permanent deflation and recession, then yeah, we'll have current account surpluses for the foreseeable future. But leaving theoretics aside, no, I think any real recovery in Turkey will immediately trigger current account deficits. And there can be no real and sustainable recovery in the Turkish economy until I receive confirmation from monthly import data that at least raw materials and intermediate goods imports are registering an increase. The same thing is true about the May industrial production data.
Yes, in the details,
Yeah,
yes.
I really don't care much about the annual figure. I care about the monthly change and the trend developments. Second quarter is definitely better than the first quarter. On the other hand, key industrial sectors still exhibit weakness, such as automotive. It appears to me that the renewed strength in the industrial sector is driven by exports, which are miraculously still holding up, and perhaps some summer stocking in view of the upcoming tourist trade. Uh, I think these developments will continue over the summer because, as I've said, the main impediment to Turkish economic progress and other currency volatility is not in the cards for the next 2 months or so. But Turkey's real problems are not being addressed. The banking side remains the biggest problem. Banks are no longer able to make loans. I mean, that's apparent. In July, loan growth turned negative again, and no modern economy can grow without loans. Two, economic growth is largely a matter of economic confidence. And economic confidence in Turkey is driven by geopolitical developments. We have covered in the fifth episode, previous episode of Real Turkey, economic confidence, despite indices showing the contrary, is extremely weak. Turkish savers are still increasing their FX assets. Turkish businesses started investing abroad rather than building up capacity at home. Uh, Ankara may not be worried about S-400s and the new tensions in EU relations because of Cyprus, but the woman on the street is extremely concerned. The businesswoman in the corporate suit is extremely concerned. There are two things that need to be done for this recovery to be more than a dead cat bounce. First, of course, we need to work out our difficulties with the West, which is not only a political ally, but also the main source of our financing,
Finance.
trade, and investment. Two, uh, AKP needs to have some kind of structure to this presidential regime. As Fitch said, there is no visibility. And without visibility, a modern economy cannot make long term plans. People will not buy houses with 10-year, 30-year mortgages. And I really don't see enough from the recent explanations by AKP heavyweights that Ankara is willing to overhaul the presidential system or to make any kind of moves to a rule-based system which would address this deficiency in visibility and foreseeability. So for the time being, my conclusion is no, I think we're seeing a summer rebound. Enjoy it. Eat, drink your Mai Tais and go to the Greek islands, as many Turks do for summer vacation. But in autumn, the bill will come and the piper will demand payment.
So how about rate cuts? Now that the central bank governor is sacked and our president openly announced that we're going to be seeing some rate cuts in the months ahead. So how will it impact the summer months? Maybe have limited impact, but combined with all the economic sanctions that Turkey is about to face, combined with the fact that our maybe the second quarter recovery was mostly based on like crazy spending from the fiscal side, which just doubled the budget deficit to GDP ratio, which doesn't look really sustainable for the second half of the year. There is no fiscal spending, but there is going to be some stronger than expected rate cuts. How will they impact the Turkish economy, the currency, beyond the summer months, do you think?
Well, first of all, I think Turkish inflation is still high, but the pass-through from the Father Brunson event, by vis-a-vis the currency, has largely been eliminated or is over. So a 200 basis point cut, which is the Reuters survey consensus, is reasonable. I would rather do it after I see the Fed FOMC meeting, but fine, the president is in a rush. So I don't think a 200 basis point rate cut by the central bank would bother the markets or would immediately undermine Turkey's economic equilibrium. It appears to me, though, I fear it, that former central bank governor Cetinkaya would have enacted a 200 basis point cut too. So for Mr. Erdogan to remove him, he must demand something like 400, 500 basis point cut. In that case, of course, my view that the lira will remain stable over the summer months will need to be revisited. Such a large cut would underpin concerns of domestic investors as well as drive the Turkish savers into FX assets. More importantly, as you suggested, even if the rate cuts don't harm the currency market or the inflation outlook now, in a scenario where Turkey continues to defy United States and NATO and activates S-400 sanctions, there will be sanctions, and I'm quoting Fitch. Economically, they may not be very damaging, but from an investor sentiment viewpoint, they are going to be extremely hazardous. So Turkish lira is going to take another hit, and the rate cuts are only going to magnify these shocks. As far as whether it's going to help the economy, on the margin, maybe, but not so much, simply because at the end, representatives from AKP have admitted that troubled loans, these are not legally NPLs, non-performing loans, but troubled loans could be as large as 400 billion liras. And they're trying to come up with a solution to the corporate debt problem. As long as that corporate debt is in the middle of bank balance sheets with no clear resolution mechanism or incentives to infuse new cash into the bank balance sheets, no matter what the central bank rate is, they will be unable to loan simply because their liquidity is low. So this is the thing that needs to be done. We need to resolve the corporate debt problem before central bank policy cuts could work through the regular credit mechanism to help the economy out. No, I don't think, even if central bank cuts rates to zero, I don't expect a rapid boost to the domestic demand, to be perfectly honest with you.
Okay, so we'll have a week full with action in Turkey again, it seems, looking from the weekend. So thank you very much, Atilla, and thank you very much for everyone who is spending time to listen to us. See you next week.